In this video, we're going to look at 3 companies under $10 per share with some massive upside potential, so stick around. What's up, guys? Welcome back to the TipRanks YouTube channel. I'm Richard Allen. Thank you so much for joining me for another video. In this video, we're going to talk about 3 companies under $10 per share that has some massive upside. One of them is actually over 100%, and the other 2 are pretty darn close. So let's jump right over to TipRanks.com. We're going to talk about Electric Last Mile Solutions. That's the first company on the list. Ticker symbol there is ELMS. This company is specifically in the automotive industry in the electric vehicle segment. Electric Last Mile is based in Troy, Michigan, near the heart of Detroit's historic automotive industry. It's an EV company developing a customizable vehicle and boasts a 675,000 square foot assembly plant in Indiana that at full capacity will be able to produce 100,000 EVs annually. It's a big factory. The company is aiming at the commercial market and urban areas with a delivery van in pre-order now and a Class 1 commercial truck under development. These vehicles are aimed at the last mile, the final leg of the delivery chain in transport networks. The delivery van that they've developed has a 150-mile range and not the biggest cargo capacity. However, this sort of last mile delivery van is exactly what a lot of companies need. ELMS started trading on NASDAQ this past June after completing a SPAC merger with Forum Merger 3. The transaction brought in $379 million in new capital to ELMS. Stephen Volkman here, a 5-star analyst from Jefferies, says, oddly, companies and markets have focused on electrification in heavy and medium truck markets, despite significant range and cost challenges. In our view, the Class 1 through 3 or last mile market represents a much more significant opportunity for BEVs, as these vehicles tend to have a relatively low level of daily mileage, right around 50 to 60 miles per day, and return to a home hub for consistent charging every evening. We estimate a total addressable market of over 800,000 vehicles per year as e-commerce continues to drive higher demand for delivery vehicles, and we expect this segment to electrify fastest, driven by government incentives and corporate sustainability goals. He continued, ELMS will be the first company to address these markets with a vehicle already at cost parity with internal combustion engine vehicles and lower total cost of ownership. Assuming ELMS can successfully launch its vehicles as planned, we believe it can likely sell out its production for the next several years. If we take a peek down here at ELMS, you can see that this gives a strong buy rating based on 5 analyst ratings with an average upside here of 85.5% for ELMS. That's some big upside right there, but they are trading right around $8 per share currently, so quite a bit lower than that $10 SPAC price for Forum Merger 3. All right, second company we're going to talk about also has ties in the automotive industry. It's Ouster, or ticker symbol OUST, but this is a San Francisco-based tech company making LiDAR systems, a vital sensor technologies used in autonomous vehicles. LiDAR allows self-driving cars to see the road and traffic around them, both vehicular and pedestrian, in real time. It's a vital link connecting an autonomous vehicle's AI brain with the real world. This was another company that entered the markets through a SPAC merger in a deal that valued the newly public company at $1.9 billion. Ouster received $300 million in new funding from the deal and started trading on the NYSE on March 12th. In business news, Ouster scored a major deal with Plus, a provider of autonomous trucks, to supply LiDAR sensor systems, up to 2,000 systems. The end user here will likely be Amazon, as the e-commerce giant has contracted with Plus to provide autonomous delivery vehicles. This deal, putting Ouster in Amazon's orbit, got the attention of Richard Shannon, a 5-star analyst with Craig-Hallum. Shannon notes Plus's announcements of its contract with Amazon and then adds that the truck maker has already committed to contracts with Ouster. In this view, this will provide long-term support for Ouster. OUST's announcements of its win with Plus for a minimum 2,000 sensors came just 2 weeks later. OUST had hinted the end consumer was a major US player, and after the 8K, we're fairly certain it's Amazon. OUST indicated its win could be worth 160,000 sensors, implying AMZN is considering outfitting 80,000 trucks with autonomous technology over the next few years and showing the industry is ready to adopt this technology at scale. Richard Shannon added, "This is a major win for OUST and does two things. One, it shows that the demand for LiDAR and autonomous trucking is real and here today, and the biggest players in the world are getting involved. And two, further establishes OUST as the current market leader for LiDAR and trucking application, as no other LiDAR maker has a production contract or an end customer as impressive as Amazon." If we scroll down here, we see that Richard Shannon rates OUST shares a buy and gives it a $20 price target, suggesting a upside of 128% over the next 12 months. But we see 3 buy ratings here, strong buy with an average upside now of 90.51% for ticker symbol OUST. All right, third and final company we're going to talk about is CareCloud Incorporated, ticker symbol MTBC. This is a medical and healthcare IT provider offering tech services and support for all facets of the medical sector. The company was formerly called MTBC, but changed its name in March of this year. The business remains the same, however. Tech support and cloud-based solutions for medical billing, practice management, transcription, and other vital back-office support for physician practices and hospitals. CareCloud will report its Q2 results this week, but a look back at Q1 earnings may be useful. EPS came in at a loss of 36 cents, which was improved the 42-cent loss reported in the year-ago quarter. At the top line, revenue was down sequentially for the second quarter in a row, but at $29.8 million, it was up 36% year over year. The company reported $21 million in cash on hand. On June 1st, CareCloud announced that it had completed the acquisition of certain assets from Medmatica, a major name in medical staffing and back office consulting. The assets acquired include Santa Rosa Staffing and Medmatica Consulting Associates. Financial details were not disclosed. In a statement for management, CareCloud said that the new assets will allow provision of a broader range of services to health system clients. All right, among the bulls for CareCloud is Cantor analyst Stephen Halper, who noted, with the acquisition of CareCloud, the company added a SaaS-based EHR application. The company's large offshore workforce is a competitive advantage in its pricing as well as how it integrates acquisitions. Indeed, acquisitions have been an important component of the company's growth, and we expect that to continue. The analyst added, "We think MTBC shares are inexpensive on an EV/EBITDA basis. However, the company's capital structure is complex given the previous issuance of perpetual preferred shares. We believe MTBC is contemplating simplifying its corporate structure, which we believe would serve as a catalyst for the shares. Even with the preferred, we believe MTBC shares are very attractive at current levels." Helper gives MTBC a buy rating with a $15 price target that indicates confidence and around an 88% upside over the year ahead. But if we take a peek at all the ratings here, they are 5 buy ratings with an average upside of 104.8% for MTBC. Guys, thank you so much for joining me for another video. Let me know which one of these 3 stocks is your favorite stock under $10 with big upside. I would love to hear from you down in the comments. And guys, I'll see you in the next one.